Today, I'll talk about the timeless wisdom from the investing legend Warren Buffett. I'll walk you through his 8 core investing principles so you can apply them to your own financial journey. So let's get right in. With number 1, stay in your circle of competence. This rule is incredibly powerful. Only invest in the business that you truly understand. Now think about this way. If you can't explain how a company makes money to a, let's say, 10-year-old, you probably don't understand it that clearly yourself. So you shouldn't be actually investing in that company if you don't understand yourself, right? So this isn't about being the smartest person in the room or understanding each and every cutting-edge technology. It's about knowing your strengths. If you're an expert in retail, look into retail companies to invest. If you understand manufacturing, focus there. Investing outside your area of expertise is really risky. It's almost like gambling. So stick what you know and the chances of success is always higher. Alright, the next one is always have a long-term mindset. This principle is the foundation of Warren Buffett's success. Always invest with long-term time horizon and think like an owner, not just your investor, but as an owner of that business. When you buy a stock, you're not just buying a piece of paper, you're buying a piece of real business. Now let's say, for example, would you buy a house or even a farm to get a quick profit and sell it next week? No, right? So treat your stocks the same way. And remember this, the greatest advantage in the market belongs to those who wait and not those who rush. By focusing on years, even decades, you allow compounding to work its incredible magic, turning small investments into significant wealth. Moving on to the next one, value investing. Buffett doesn't buy any stock at any price. He practices value investing. This means he buys a stock only when its market price is significantly lower than what he believes the company is truly worth. He's looking for a margin of safety. Now imagine buying $100 for, let's say, $60. So meaning you're getting a $40 discount, right? So that $40 is basically the margin of safety, or he's looking for that safety net. He loves buying stocks during tough times. Let's say a bear market or a very good company is struggling. That's the time he will invest the most, because that's the time you will get very good discounts on very good companies. Alright, the next one is something that even I tell my viewers, that's buy productive assets. This is very crucial. Invest in things that actually produce cash flow and grow in value. What does that even mean? Think about a business that sells a product or service that's generating cash flow month on month. For example, a rental property. Using that, you are getting rental incomes, meaning that's a productive asset for you. Or maybe it's a dividend investing stock that's monthly giving you a dividend income. So try to buy those sort of productive assets. Buffett focuses on owning pieces of excellent businesses because they're inherently productive. They work for you, compounding your wealth over time. Next up, Buffett's favorite holding period is forever. But he sells if the moat of the company is breached. Now, what do I mean? It means he will hold the company, he intends to hold the company forever, but if the moat of a company, meaning the competitive advantage of that company, is breached, let's say he bought a company and the management changed and they're operating in different ways, then he would not hesitate to sell his shares. It's always about owning great businesses and not just shares for the sake of it. So if the competitive advantage is no longer there, Buffett will sell it off. So the next one is invest only when there's a strong moat. So Buffett got a famous concept, only invest in companies that have a strong, identifiable competitive advantage. That is a moat that protects their business. So what's a moat? It could be a powerful brand name that customers like let's say Coca-Cola, or a company with a unique technology or patent like Apple. So those sort of companies are great companies that's worth Buffett's investments. So a deep moat allows a company to maintain its profitability and grow over the long term, making it a much safer and more reliable investment. Without a moat, profits are easily eroded by competition. Alright, the next point is more of the psychology. So investors should be emotionally intelligent. It's not just about finance or the numbers. It's a lot to do with the psychology. So an investor must be emotionally intelligent. This means having a contrarian mindset, meaning you're willing to buy when others are fearful and sell when others are greedy. Incredible discipline to stick to your plan, immense patience to let your investment grow, and using your inner scorecard. An inner scorecard means you judge your decision based on whether they were logical and sound, not just on whether the stock price went up or down that day. Don't let market noises dictate your actions. And finally, the last one is position sizes. When Buffett finds an absolute gem, a company he deeply understands, bought at a great value with a great moat, excellent management, and a long-term outlook, he doesn't just put a little bit of money. He goes all in. He goes big. And he famously said, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. This means when you research and the convictions are really high, don't be afraid to make that investment a significant portion of your portfolio. Your best ideas should be your biggest positions, as these are the ones that will drive the majority of your long-term returns. So there you have it. 8 core investing principles by Warren Buffett. Which one of these are you following already or you intend to follow from today? Let me know in the comment section. If you like what I do, give it a thumbs up, subscribe to my channel, and share with your loved ones. Thanks for watching. I'll see you in the next one.